We're getting the latest look this morning at the state of Canadian jobs. Statistics Canada released its latest labour force survey last hour. More than 40,000 jobs were added to the economy last month.
Okay, some big news on some big numbers there. Welcome to About That. I'm Lauren Bird, in for Andrew Chang. Canada's latest job numbers are out, and once again, they have blown past expectations. Economists were expecting 20 to 25,000 jobs, but we got a lot more, 41,000, continuing Canada's higher than expected job growth, and that's huge. We've been following the jobs data closely on our show because jobs and employment shows us how strong the economy is. And if we've been hearing anything in the past year, it's that the Bank of Canada wants to pump the brakes on the economy, to raise interest rates to slow the rate of inflation. And that means less job growth. Basically, big jobs numbers are actually a big problem. And another thing, there's more demand for jobs than workers. And until that levels out, the economy will run hotter than the Bank of Canada wants. Wages are going up. These latest numbers show us that there's a 5.2% increase in hourly wages from this time last year. But the cost of living is more expensive, so it's like this vicious cycle. So what's actually going on here? Do strong jobs signal a soft landing for the economy, or is there more pain on the horizon? To understand the concern of jobs, we have to understand inflation. Last summer, it was the highest it had been in 40 years. One of the Bank of Canada's only tools to bring it down to target, 2%, is to raise interest rates. And it did, like fast. From January of 2022 to January of this year, interest rates went from 0.25% to 4.5%.
Right now, we've been very clear, we're pausing to assess whether interest rates are high enough to get us back to the 2% target. That doesn't sound like a conversation about cutting, does it?
So the expectation is that the rate hikes would slow spending. Companies would invest less, hire less. In theory, fewer jobs means less spending, so less money driving the economy, and that means a lower rate of inflation. And it's been working. The rate of inflation has been decelerating, but the job market really doesn't seem to be getting the memo.
The labor market needs to rebalance. It's still very tight. Wage growth needs to moderate to get inflation back to 2%.
So if we take a look at the jobs data from the previous 5 months, I mean, just look at December, 104,000 jobs added. In January, 150. There's a bit of a lull there in February, but March, 35,000, and that brings us to April. Every month, more jobs than economists were expecting. And a historically low unemployment, a steady 5%. Remember, the economy was bracing for 20 to 25,000 jobs in April. Got almost twice that. Clearly, there is some kind of disconnect between expectations and reality. So there's some good news here, but some bad news too. So to sort through it all, I'm going to go back to the studio to chat with CBC senior business correspondent, Peter Armstrong. Peter Armstrong, hi.
Nice to see you.
Yeah, thanks for being here.
Let's talk jobs.
Yes. Okay, so when Tiff Macklin talks about rebalancing the labor market, what exactly is he talking about there?
Funny little word, isn't it? Look, you touched on this, that what they don't want is a jobs market that's booming because that tells you that the economy is booming, right? When you're adding 41,000 jobs in a month, that is not the sign of a slowing economy. And the whole enterprise here is to slow down the economy. That if you buy less stuff and I buy less stuff, then there's less competition for stuff and prices should come down. That's the whole play. That's why they hiked interest rates. That's what they're trying to do here. And for the most part, that's working. The economy itself is slowing. Right. But if you're adding jobs by the tens of thousands every month, that's a sign that maybe something's not quite working in there. So what they want to see is less hiring, for sure. It's not like the Bank of Canada's out there saying, we want everybody to lose their jobs and this is going to be a disaster. They don't want that. And, we can get into what the vacancies, actually how that fits into the picture. But mostly what they want is a jobs market that is reflective of a slowing economy. And right now, when you're adding this many jobs, that ain't it.
So how slow is going to be enough, though? Like, when does it cool off enough?
Yeah, look, that's kind of the million-dollar question. And it's, it's like, pornography. You know it when you see it. And I think with this, they will know it when they see it. And, you have to look at all of the economic indicators. Jobs are telling us one thing. GDP is telling us a different thing. The inflation numbers coming down, right? The rate of inflation, as you say, went from 8.1 to 7 to 6 to 5. We're expecting next week to get it down at 3.9%.
Wow.
So they're all telling us different things. And that's natural. That's going to happen at an inflection point in the economy. When things are changing, you're going to get contradictions. That's just kind of the nature of the beast. And so trying to parse through those contradictions is the job of a central bank and, frankly, of economists and of everybody who's a market participant, as they call them. So what they're trying to do is figure out what that line is. And we don't know, because how few jobs do you want to see added? Well, it depends on how the economy is expanding. If the economy has slowed to zero and kind of sits there, then that's kind of job done, and you don't need to worry about the jobs. But if they start to counter-indicate each other and the jobs are showing you that the economy is starting to pick back up again, that's where it gets into trouble.
So if GDP hasn't come down quite enough, if all of these other factors don't fit in, then we need to lose more jobs, is what you're saying.
Well, you need to do something, and jobs would be a sign that something's gone awry, right? But right now, GDP is at 0%. It was at 0.1% in February. We're expecting it's going to be at negative 0.1% in March, and that's right on target. That's where the bank thought we would be. That's where the bank kind of wanted to get us to. And then it expects that should pick back up. So maybe this jobs being too hot is a bit of a red herring. We just won't know until we get there.
Does that mean that we could be potentially seeing a soft landing that we've been
That's the
talking about?
scenario, right? The bad scenario is that we overshoot, the economy goes into the ditch, and we lose all these jobs, and everything goes haywire for way longer than we had expected. The soft landing scenario is that GDP kind of sits where it is now, jobs continue to get added, everybody's happy. By the fall, we see the economy start to pick back up again. We've got inflation back below 3% maybe by then. That's the soft landing. And that scenario is very much in play. Will we get there? I mean, listen, every crystal ball on the planet is broken right now, so I don't trust any of them. But the forecasts are pretty split. That we could well get there. We could well overshoot and end up in the ditch. We just got to kind of wait for the data to tell us what's happening.
Amazing. Okay, so what's the next piece of data you're watching out for?
Look, the big one this week, we've got U.S. inflation numbers on Wednesday. We get Canadian inflation numbers next week. We've got retail sales coming in that'll tell us what those consumers I was talking about are going to be doing. There's a lot at play here. This week is a bit of a lull. We get the big one is the U.S. numbers. Next week with the Canadian CPI numbers, with retail sales, there's a lot about to come in that's going to tell us not just where we are, but where we've been. And that's going to inform us about where we're going. And I think that's kind of the most important thing.
Absolutely. Well, we will definitely be watching. Peter Armstrong, thank you so much.
You bet.